Hi there, I'm Miranda Alt with Keller Williams Success Real Estate and the Miranda Alt team. Thank you so much for watching. We are at Wisdom Wednesday, and today we are talking with Eric Schroeder from Mortgage Capital Group, of course, my most trusted mortgage advisor. And what we want to talk about today is something that I've heard people talking about on the golf course and at dinners, and people are bringing up the fact that there's new pricing for Fannie Mae and Freddie Mac, and people seem to think that they are being penalized for having good credit. So I wanted to bring Eric on today so that we could really hear the specifics about what this new pricing entails and what it means for you. Eric, thank you so much for joining me today.
Thanks for having me again.
Okay, Eric, so what's the deal? Are we all now being penalized for having good credit?
So I'm thinking of it like this. What Fannie Mae and Freddie Mac did is they came out and they're adjusting to help people afford homes. So the problem that, and what they're talking about and who they're looking to help is those that don't have as good a credit or as much money down. So I think it's pretty easy for people to understand that if you have, if we think about, like grades in school, if you're an A plus student, so you've got good amount down and you've got excellent credit, this is 780 and above credit scores, you're going to be okay. You're going to be the same. There's no help for you. There's not really a hurt for you. It's okay. But those folks, most people fall in line where they're in the 680 to 780 zone, where they're taking good care of their credit, but maybe the balance is a little bit high. Maybe they've got a new car, payment or something. A lot of things go into your credit that maybe make your scores be 740 or 720 or 760. And so those would be your B plus, to C minus folks. And for those people, that's who's getting hurt a little bit. And what it means is that you're going to just pay, a quarter more in interest rate if you fall into that B plus to C minus student range. You're going to get about a quarter higher in rate. Of course, the way that it works in mortgages is that you don't have to take the quarter hit in rate if you just give the bank more money. So you could just pay an extra, depending on your loan size, $1,500 ish, something like that, to then get that mortgage rate to where it would be before these changes went into play. So, it's a little bit more expensive for those B plus to C minus students. Now, the D's and the F's and, maybe even the C minus, they may even see a little improvement. So they certainly won't get the interest rates and the closing costs that the A people get or the B plus people get or the B's get. They're always fishing down with the higher rates and the higher costs. Well, things just got about $1,400 cheaper for them. So that's it. I mean, you're people with good credit are always going to get a better deal than people that have bad credit, or people that are putting more money down are always going to do a little better than people that are putting less money down. It's just that, just imagine the bottom has gotten a little better and the top has gotten a little worse, kind of thing. Excluding, of course, the 780 and above, and then, of course, excluding, which isn't, of course, and I think very interesting, folks that make less than the 80% of the median household income for our area, which is 84,650. Those people are not being affected at all. That they're not part of this deal. They
People
get
making
exempt
less than that?
less than. So if you've got a husband and wife that are applying for a mortgage and they make more than 84,650 together, what I've been doing with my clients is we're just grabbing the wife's income or the husband's income, trying to qualify them that way. Because if you get an interest rate, when you get an interest rate and your income is over 84,650, your rate is going to be 0.5% higher than families that make less than 84,650. So what I find very interesting that nobody's talking about is really there's a 0.5% difference in rate for those families and those individuals applying for a mortgage that make less than median household income versus those that make more.
So if you make less than 84,000, 84,500, did you say?
$84,650.
Okay. So if you make less than 84,650, is that just here in McHenry County, or is that like the state?
Great question. You have to go, it's the median household income for individual counties. So Kane,
Oh,
Kendall,
counties.
McHenry, that's all the 84,650, which this gets adjusted every year, by the way. So I believe every summer now, we're heading into June, July, August, the time to adjust this would be now this summer. Keep in mind those folks that are earning less than the median household income are exempt from all these Fannie and Freddie changes.
And so what does it mean for them?
The ones that make less, you're going to see about a 0.5% better interest rate than families that make more than 84,650.
So those people are getting a better interest rate. It's not that they are getting of any money at closing. There's nothing like that happening.
Nothing. I mean, there's programs that are grants and things, but that's something else.
Are those the
altogether.
same people that also apply for FHA loans though? And also for like, is this for an FHA loan? Because if you're only
Yeah.
making $84,000 a year, I would think you're going to go FHA.
Oh, no way. I mean, really, we try to keep everybody away from FHA, but conventional loans, this is for conventional loans. FHA is exempt from all of this stuff. They're always happy to give anybody a mortgage. They just charge 1.75% upfront. It goes directly to the government. So there's just extra costs that come and are involved. Their mortgage insurance per month has gone down. That's been some of the changes that have happened. But still, you're going to find yourself an advantage. I have found if you're making less than 84,650 a year, still going with a conventional mortgage.
Okay,
Or
so this is
FHA.
all for conventional mortgages.
Mhm.
And so if let's just talk interest rates if you can, and I know that it's not specific, but if
Yeah.
let's say I make $84,000 a year and I come to you and I want to get a mortgage, what's my interest rate going to look like right now?
I mean, you would say, and again, that's affected,
And I have to still have 5% down to get conventional, correct?
3% down.
3% and I
Yeah.
can get conventional?
Yes, and we've got programs where you just do 1% down, and then the bank will actually supply the other 2% down. If you make less than 84,650, all kinds of good stuff for folks that make under 84,650.
Okay, so then
Above that,
I have another question. Okay.
yeah,
So if I make less than $84,000 and I can bring only 1% to closing or if I can put just 1% down, there are some people that have been asking me, well, this sounds a lot like 2008, where they're giving mortgages to people who shouldn't get mortgages. What do you think about that?
Well, it wouldn't be similar to 2008 because the problem that was in 2008 were your no document loans. So that would be
Okay.
can't prove your income. Um, you know, we would give people loans that had 500 credit scores. Never mind 580, 620, 660. It was all the way down to 500. So then they also have the no document loans. So where the programs are coming out and saying, okay, if you only have 1% to put down, we'll get you a mortgage. They're qualifying you. They're saying, yeah, but you've got good credit scores and you've got a job to support the home. And so we just have this special program that'll help. That's different from 08. 08 was like, if you've got a pulse, put no money down in investment property, we don't need to see a pay stub.
Okay, wait. So 84,000 is just your income. That doesn't mean you have bad credit and you don't make enough money. That's good credit and but you just don't make enough money.
Yeah. So we started off the conversation, just for everybody, so that everybody's getting lost. We started off the conversation by saying, what happened to the good credit people and what's happening to the bad credit people? And why are the bad credit people getting help? And why are the good credit people not getting help or getting hurt? And they are. But you cancel all of that out if you make less than 84,650 or one of two people borrowing. Now all those rules are out the window. You don't have to worry about any of that stuff. It's just, so really what we started with today is good credit people with B plus or B credit making over 84,000 a year will spend more money getting a mortgage.
Got it.
If
It's
you
just
make
gonna be more
less than
expensive.
84, it doesn't matter. Yeah.
Okay. Okay. All right. It is a lot. It's very confusing.
It's totally confusing. I know.
It's so confusing,
Yeah.
which is why I tell people to just call you.
Well,
When people
really,
start asking me questions, I'm like, this is not my department. This is why you call Eric. But it is important that you understand it really well, because even if I don't understand it really well, you understand it really well, so you can help guide the people to what they need.
getting pre-approved in advance of going to look at homes is important message here. Everybody's an individual fit. Everybody can be, like we've got the two spouses that make over 85,000 a year. Maybe we could split one off. I can help. We could do getting pre-approved and talking to a lender before you begin shopping is so important for understanding what you could be approved for and also getting an idea as to what payments are. And that's dependent on your interest rate. I mean, we need to get you figured out before, Miranda, you start showing them homes. That's
I know.
important.
And you know, what's so funny is I was just doing some research on Monday for my Monday market update. And one of the things the USA Today article that I was reading was talking about was how important it is to just get pre-approved so that you can be ready when you do find the right house. Because a lot of people do start looking before they get pre-approved, and it's like you're putting the cart before the horse. And if you're not ready to write an offer the day you go look at a house, you might find your dream house, but then you can't write an offer because you're not pre-approved.
Yeah.
And that's such a pickle to be in, especially in this market. So, all right. Well, Eric, thank you so much for your time. I appreciate you doing your best to clarify this for me, who does not understand all this stuff. I'm so glad that you do. But I think I think this was very helpful. I think it certainly helped untangle the web and answer some questions that I know people have had for me. So thank you.
You got it. Thanks for having me again.
All right. I'm Miranda Alt with Keller Williams Success Real Estate and the Miranda Alt team. Eric Schroeder is at eric@mcglending.com, or you can call his office at 815-455-4422. Thanks again, Eric. Have a great day.